Hello everybody, welcome to MoneyWorks. My name is Neil Mardian, certified financial planner and investment advisor here in Medicine Hat. Thank you for joining us. Today we have a special guest, Mr. Morgan Harrison, chartered accountant and partner here at the local EBT firm here in Medicine Hat. Today we're going to talk a little bit about some often missed tax deductions personally that people sometimes miss. So Morgan, give us some examples of some things that people sometimes just overlook.
Probably one of the most common areas we see is interest on funds borrowed for an investment. That doesn't include money put into your RSP or your tax-free savings account, but would include things like money borrowed for a rental property,
right.
Not just the mortgage on that rental property, but the down payment as well.
Okay.
Money borrowed to purchase stocks, bonds, mutual funds, and also loans to a private corporation or the purchase of a private corporation, buying the shares themselves. It's really important to make sure that you do deduct that interest. Your savings, depending on your personal tax situation, can be up to 39% of the actual interest, so that's really substantial. And if you happen to have got into a situation where you bought something and you not with borrowed funds and you do still have, say, a mortgage on your house, you could look to capitalize on this by selling that actual investment or repaying it, paying down the debt you have, reborrowing that debt, and then repurchasing that same investment. So it's something important and something to talk to your financial planner about how it fits in your situation. The next one would be charitable donations.
Okay.
Charitable donations, it's not that people necessarily miss it, but it's something to really think about what's happening or how much you're saving in tax when you're actually contributing.
Right.
Everything over $200 in Alberta, you save about 50% of the tax on that.
Wow, that's a lot.
So it really is substantial. There's a couple things to really watch out for, though. One is to ensure that if you don't know that charity, to ensure that they do have charitable status. You can go on to CRA's website at www.cra.gc.ca and you can search that. And you should also watch for donation schemes that promise a larger tax refund than the actual money that you're donating. So CRA's really sort of cracked down on those in the last few years.
Yes.
The last one is the disability tax credit. That would be for a taxpayer that is markedly restricted in some aspect of their life. That might be seeing or hearing, walking, dressing, or mental functions, and the list kind of goes on. There is a list of specific diseases that CRA does consider for this. It's something to check again on CRA's website. The form T2201 is the form you have to fill out. You do about half of it. You get a qualified medical practitioner. Depends on what it is, who must fill it out. But your annual tax savings is about $2,500 a year. And you can then, once you qualify for this, contribute to a registered disability savings plan, an RDSP, where the government actually matches some of the funds that go in there. So it's a great tax savings and something to watch and make sure you look at if you think it might apply to you.
Perfect. Well, those are some great tips just for the personal taxpayer out there in order to be able to save a little bit of extra money, keep more money in your pocket, less money in the government's pocket. Again, thank you for joining us today on MoneyWorks. My name is Neil Mardian. Thanks, Morgan. And remember, people don't plan to fail, they sometimes just fail to plan.